So-called tail risk funds are attracting investors looking to hedge against market volatility. Now, these funds tend to post losses when markets are calm, but can reap huge gains when disaster strikes. Well, joining us is someone who manages one of those tail funds. Vaughan Robinson is head of risk at Bennelong Asset Management. Vaughan, good to see you. Just explain your tail fund. Just how does it work?
Sure, Ian, thanks for having me back. I think there's two key features of tail funds. As you said, they tend to lose money during normal market conditions, whatever that means. But they also tend to do quite well during volatile market conditions.
And how? What are you actually hedging against? What are you actually putting money on here?
Well, I mean, the funds, beyond those, that type of return profile, the funds themselves tend to have a multitude of different things that they're playing for. So they might focus, for example, on Japan specific. They might look at credit. You might get more varied funds. Some might have a European-specific focus. Some might only look at equity puts. You get a very wide range of funds.
And tell me about the sort of investors that you have. Is it a mixture of private investors, institutional investors? Who would come to a tail fund?
It is a mix. I think it's much easier for an individual or a family office or a high net worth individual to be able to allocate money to this, because it is very much the type of investment where you want to sort of set aside an amount of money and then not worry about what it does in the interim and just hope it's there for you in extreme volatile conditions. Fund of funds, because of the negative return profile during normal market conditions, tends to be more difficult for those types of institutions to get their head around and allocate to these type of funds.
Now, I understand the fund that you have, it's doubled in size, has it not, in recent months, to something like $80 million. But that's still quite small when you compare it to other funds. I'm just wondering what sort of proportion people use as their investment strategy.
I think it varies. I mean, some people are definitely using it as a hedge to an existing portfolio, whereas some people are using it as an actual view. So they're allocating maybe more than they would do normally to an insurance-type product. In terms of the size, I think with a couple of exceptions, the funds do tend to be quite small. And I think that's probably the way it's going to remain. I mean, for example, our fund, we don't really want to get much more over 200 million. I think we're 80 million at the moment. And there's a particular reason for that, and that you don't want to dilute the returns for investors who've allocated money to you already.
So what sort of returns are we looking at? It all depends on what happens. I suppose you'll be jumping for joy if Greece defaults, right?
Well,
harsh question,
there's two ways to look at it, and actually my wife is Greek, so it makes it very different and personal for me. I think in terms of the returns that people are looking for, and actually this comes back to fund of funds being able to allocate to these type of funds, now that they've been apprehensive, they've been following a lot of funds, and there's been interest in meeting with tail risk funds, but they haven't allocated yet, and I think part of the reason is that they were waiting to see how they would perform. Because it's all well and good talking about a portfolio of these types of assets, which in our case tends to be an eclectic mix of oil calls and puts on various indices, currency options, credit default swaps, all this sort of stuff. But they've got no idea necessarily of how that might perform or how that might influence their return profile once they have this as part of their asset mix. But in terms of the prospect, it's very path dependent and very specific on the events that you're looking at playing out for. I mean, some events could see the fund increase tenfold. Others might be a little bit more modest. So a 10% pullback in equity markets, for example, we'd expect to be making money, but certainly not necessarily triple-digit returns.
Okay.